The markets are hitting all-time highs. The headlines are euphoric. Everyone seems to be making money. And that's exactly what a seasoned investors worry. Today, we're going to dive deep into why some of the most experienced asset managers are quietly moving to the sidelines and what that could mean for your financial future. Let's start with what we're seeing in the stock market right now. The NASDAQ 100 and SP 500 have been on an incredible run. But here's what most people miss: these indices are being carried by a handful of tech giants. It's like a boat being pulled by a few strong rowers while the rest are just along for the ride. When we look at market history, this kind of concentration usually isn't a good sign. In fact, it often precedes what traders call a blow-off phase, that final surge of euphoria before reality sets in. Think about this. We've had one of the longest bull markets in history, fueled by over a decade of historically low interest rates. It's like we've been running a marathon on performance-enhancing drugs, and now we're starting to see the side effects. Smart money, the big institutional investors and experienced asset managers, they're not sitting still. They're quietly making moves, and these moves tell us a lot about what might be coming. First, let's look at what they're doing with their portfolios. Many are starting to shift small but significant portions of their holdings into what we call safe haven assets. We're talking about treasury bonds, gold, and silver. Now, why would they do this when stocks are hitting new highs almost daily? Because they understand something crucial: the higher the market goes without a meaningful correction, the more potential energy builds up for a significant downturn. It's like stretching a rubber band. The further you pull it, the more forceful the snapback will be. But here's where it gets really interesting and concerning. The traditional safe haven of treasury bonds isn't as safe as it used to be. Why? Inflation. And not the transitory kind we were promised. We're talking about persistent structural inflation that's becoming embedded in the economy. When inflation runs hot, bond yields typically rise to compensate investors for the loss of purchasing power. But rising yields mean falling bond prices. This creates a difficult situation for long-term bondholders. They're essentially guaranteed to lose money in real terms. This brings us to commodities, an area that's starting to catch the attention of savvy investors. While everyone's been focused on tech stocks and cryptocurrencies, commodities have been largely ignored. Many are still trading at historically low levels relative to stocks. But here's the key: commodities are real, physical assets. You can't print more copper or silver the way you can print money. In an inflationary environment, these hard assets tend to perform well. Speaking of hard assets, let's talk about the ongoing battle between Bitcoin and traditional precious metals like gold and silver. Bitcoin has had an incredible run, but there's growing speculation that we might be approaching peak Bitcoin relative to gold and silver. This is particularly interesting when we look at silver. Silver is both a precious metal and an industrial metal, crucial for everything from solar panels to electric vehicles, yet it's still trading well below its historical highs. Some analysts believe silver could be setting up for a dramatic move higher, potentially outperforming both gold and Bitcoin on a percentage basis. Now, let's zoom out and look at the bigger picture. Central banks, especially in Western countries, are in a bind. They've painted themselves into a corner with their policies. They can't raise rates aggressively without causing serious problems in the debt markets, but they can't let inflation run wild either. This dilemma is leading to some fascinating developments in the global currency landscape. We're seeing countries with a history of central planning potentially taking the lead in establishing new, more stable currency systems. Meanwhile, traditional fiat currencies are showing their limitations more clearly than ever. But here's what most people miss: these changes, while potentially disruptive in the short term, might actually lead to a healthier financial system in the long run. It's like forest fires. They seem destructive, but they're often necessary for the ecosystem's long-term health. Let's break down what this means for different types of investors. For long-term investors, this is a crucial time to reassess your risk tolerance. The strategies that worked in the last decade, buying every dip, staying fully invested in growth stocks, might not work in the next decade. Consider diversifying into assets that perform well during inflationary periods. For active traders, watch for signs of market exhaustion. When you see previously skeptical investors capitulating and jumping into risky assets, that's often a warning sign. The time to be most cautious is when everyone else is most confident. For retirement savers, this is particularly important. Many retirement portfolios are heavily weighted towards stocks and bonds, a combination that could face significant challenges in an inflationary environment. Consider adding some inflation-resistant assets to your portfolio. Now, let's talk about specific warning signs to watch for. Number 1, increasing volatility in major indices. 2, growing divergence between price action and fundamental metrics. 3, rising correlation between different asset classes. 4, unusual behavior in the bond market. 5, acceleration in commodity prices. These signals don't necessarily mean an immediate market crash is coming, but they suggest we're entering a period of significant change in the financial markets. One of the most important things to understand is the role of market psychology. Markets often move based on perception rather than reality, at least in the short term. Right now, we're seeing classic signs of late cycle behavior, excessive optimism, dismissal of risks, and a belief that this time is different. But history teaches us that it's never really different. The details change, but the underlying patterns remain the same. Markets move in cycles, and understanding where we are in the cycle is crucial for protecting and growing wealth. Looking ahead, we're likely to see some significant shifts in both markets and society. These changes might include a revaluation of what constitutes safe assets, a shift in global financial power dynamics, changes in how people save and invest, new approaches to currency and value storage, evolution in how markets function and are regulated. These changes won't happen overnight, and they won't be uniform across all markets and regions, but they're coming, and being prepared is crucial. So what can you do to protect yourself? 1. Diversify across different types of assets, not just different stocks. 2. Consider adding some physical precious metals to your portfolio. 3. Look for investments that have intrinsic value and real-world utility. 4. Maintain adequate cash reserves for opportunities and emergencies. 5. Stay informed about global economic developments. 6. Be prepared for increased volatility. Remember, the goal isn't to predict exactly what will happen. That's impossible. The goal is to be prepared for different scenarios and position yourself to both protect your wealth and take advantage of opportunities as they arise. History shows us that the biggest opportunities often come during periods of major change. But to capitalize on these opportunities, you need to maintain both financial and emotional stability when others are losing theirs. As we wrap up, remember this: the current market environment is unprecedented in many ways, but human nature, the force that ultimately drives markets, hasn't changed. Greed and fear still rule market movements, and understanding this can help you make better investment decisions. Stay alert, stay informed, and most importantly, stay rational. The coming years may bring significant challenges, but they'll also bring opportunities for those who are prepared and positioned correctly. Remember, the best investors aren't those who make the most money in bull markets. They're the ones who preserve their capital through all market conditions and come out stronger on the other side.